support of our goals in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by 1/4 percentage point.
So the Federal Reserve has now cut rates again, third meeting in a row, a 25 basis point cut, projections for this year to 1.7%.
Most Americans believe one simple thing. When the Federal Reserve cuts interest rates, borrowing should naturally get cheaper. That belief is very logical, but you know what? It is absolutely wrong. The Federal Reserve cut interest rates for the 6th time in the past 15 months. The benchmark rate actually fell from 5.5% to 3.5%, a 175 basis point reduction meant to put back money in Americans' pockets. But here's what actually happened to your credit card APR. It barely moved. In fact, for millions of Americans, it actually went up. When the Federal Reserve cut rates, your APR should naturally drop by the same amount. Instead, it fell by only 23 points. Banks kept 77% of the benefit. So today, we are uncovering a truth that every American should know. If the Federal Reserve cuts rates, why can't the Fed help your APR drop? The answer reveals a hidden mechanism in American banking that has extracted $25 billion from households since 2024. And it proves that Federal Reserve is mathematically powerless to help you escape it. In the next 15 minutes, I'll show you the exact dollars this costs your family and how one missed payment can cost you hundreds of dollars every single year. As per the Federal Reserve Board's Consumer Credit Report, which was released on 4th of December 2025, Americans are carrying $1.3 trillion in revolving credit card debt. That's a record high. But the story isn't just about the total, it's about the cost. The average APR on accounts actually accruing interest sits at 22.83%. This is the highest rate the Fed has recorded since it started tracking this data in 1994. 31 years of data. And where are we? Right at the peak. You know what? Here's what most Americans don't really understand. Nearly 46% of all credit card holders, that's roughly 46 million people, are carrying balances at this rate right now. On a $3,000 balance, which is roughly what average household charged for holiday gifts this December, 22.83% APR means you're paying about $60 per month in pure interest. Every month. Remember, every month. This is just the interest. If you pay the minimum of $125 per month, $60 of that goes to the bank as profit. That is a structural trap. And before the end of this video, I'll show you the exact mechanism that created it and why the Federal Reserve cannot fix it no matter how many times they cut rate. As of Q3 of 2025, 12.41% of Americans are 90 or more days late on credit card payments. That's up from 11.13% just a year earlier. Even more troubling, in the lowest income neighborhoods, 20.1% of credit card holders are delinquent. In the wealthiest neighborhoods, 7.3%. This isn't happening because Americans are irresponsible. It's happening because the math actually stopped working. Before we get deeper into this topic and helping you uncover the truth, let me explain you how credit card APRs are supposed to work and what actually led to this. Mechanically, APR means prime rate plus margin. The Fed moves this particular prime rate. The margin, what the banks track on, is their pricing choice. Historically, these moved more symmetrically. To understand how we got here, we need to go back to 2013. In 2013, the average APR margin on credit card stood at 9.8%. The prime rate was about 3.25%. So the average APR was roughly 13.05%. Forward today, the prime rate is 3.5%, roughly the same as 2013. But the APR margin has more than doubled to 17%. This gives us a 22.83% APR on an average, a 73% increase despite no fundamental change. Here's the critical question. Why would banks charge nearly twice the margin if the underlying credit risk is similar? The answer to this question begins in December 2023. Not 2024, not 2025, but back in December 2023. That's when credit card companies led by Synchrony Financial began quietly raising the APRs across their portfolio. Synchrony issues cards for TJ Maxx, Walgreens, Amazon, and dozens of other major retailers. In December 2023, TJ Maxx Synchrony card APR jumped to 34.99%. The Walgreens card went from 23.24% to 25.99%. Cash advance rates jumped from 29.99% to 34.99%. Now here's the timing that actually matters. The Consumer Financial Protection Bureau didn't propose its late fee cap rule until March 2024, 3 months after the rate increase began. According to a report from American Banker in April 2024, Synchrony CEO Brian Doubles stated to investors, and I quote, "We are executing our plan. We've been rolling out changes since December 2023. Let me translate that for you. The banks had already decided to raise rates months in advance of any regulatory change. This wasn't a reactive move. This was actually planned. The stated reason was the CFPB's proposed rule, which would have capped late fees at $8. Previously, banks charged $30 to $41 per late payment. For Synchrony alone, this represented $2.7 billion in annual revenue. But here's where the trap actually closes. On April 15, 2025, just 4 months ago, a federal judge in Texas vacated this entire rule. The court found that the CFPB had overstepped its authority. The $8 late fee cap was gone. And do you know what did Synchrony and Breed Financial announce in May of 2025? They were keeping the APR increases. The money stayed with the banks itself. According to analysis from CFPB itself, this margin expansion generated roughly $25 billion in extra revenue that had no actual justification after the rule was defeated. The banks had essentially admitted, we don't need this money to cover losses. We are keeping it surely because we can. Now, let's get to the part that actually proves why the Federal Reserve is actually powerless. Credit card APRs work with a very simple formula. APR is equal to prime rate plus APR margin. The Federal Reserve controls the prime rate, but the APR margin, that's the spread banks actually keep as profit. That's entirely controlled by banks, and therein lies the entire trap. Let me show you with actual numbers. From September 2022 to June 2023, the Federal Reserve raised rates very aggressively. The prime rate went up from 0.25% to 5.5%. That's a 525 basis points increase. And you must be thinking at the same time, what about credit card APRs? They went from 14.56% to 22.15%. That's a 565 basis points increase. The APR went up more than the Fed raised rates. The banks didn't just pass through the increase, they added extra margin on top. The pass-through rate now was about 107%. Now watch what actually happens in reverse. From October 2024 to December 2025, the Federal Reserve cut rates by 175 basis points in total. 6 separate cuts, bringing the prime rate from 5.5% down to 3.5%. In other words, when rates go up, banks pass through 107%. But when the rates actually go down, banks pass through just 13%, which means banks keep 87% of the benefit as pure profit for them. This asymmetry isn't accidental. It's a mathematical proof that banks actually have the pricing power and they are using it. But do you know what banks will actually tell Americans? We need these high margins because delinquencies are rising. Now, let's test this particular claim that banks make. In 2013, credit card delinquencies were between 9 to 10%. The APR margin was also about 9.8%. But in 2025, delinquencies were 12.41%. So if we do the math, delinquencies went up by 37%, but the margins, the credit card APR margins went up by 73%. That's a disproportionate increase. If margins were purely risk driven, they should scale with delinquencies, but they don't. Here's what's actually happening. Delinquencies are partly caused by high APRs, not just causing high APRs. Think about it logically. And let me repeat this statement again. Delinquencies are partly caused by high APRs, not just causing high APRs. For example, a family earning $25,000 per year gets charged about 24% APR on a $3,000 credit card balance. Their monthly interest is $60. Combined with rent, utilities, and food, they can't afford to pay anything above the minimum. Now they miss one payment. The bank triggers a penalty APR of 29 to 34%. Now they are guaranteed to default. Banks then cite these defaults as justification to raise APRs even higher for everyone else. The system becomes self-fulfilling. High APRs create delinquencies. Delinquencies justify high APRs. Higher APRs create more delinquencies. This is happening to millions of Americans right now in December 2025. So now let me prove this math to you step by step. On the $2,500 credit card balance, the credit card has about 22% of APR. So if we calculate the monthly interest charge, it comes around $46 per month. Now, for a middle income American household, if most of their money during the month is spent on food, utilities, gas, car payments, they would naturally opt for paying the minimum balance. Typically, the minimum payment is 5% of the balance, which comes roughly around $125. Now, step 3 is what actually, out of this $125 payment, what actually goes to the principal. So if we deduct $46 of monthly interest charge from $125, it comes around $79. So $79 actually goes to the principal. Now, the step 4 is time to pay off at minimum payment. So if to calculate this $2,500, if we divide this by $79 of average monthly principal, it comes roughly around 31 months. And the total interest paid is $46 into 31 months is $1,426. So the final cost of $2,500 purchase to a middle income American household costs $3,926. Extra cost from the APR itself is $1,426. So now let's return to the original question. If the Fed cuts rates by 175 basis points, why doesn't your interest drop? The answer is that while the Fed cuts rates, banks don't pass through the cuts because they control the margin. They pocket 87% of the benefit. This isn't a monetary policy failure. This is a system working exactly as designed for the banks, not for an average American. And that's the hidden money flow that 46 million Americans never see until it's too late. If this video unpacked something you didn't know, subscribe for more such data-driven breakdowns in the world of US finance and its impact on average Americans' money. And if you're comfortable sharing, comment down your credit card APR. Let's discuss how to get you out of this.